Okay, the bell will ring any moment, and it looks like it's going to be an opening with a strong opening, up close to about 80 points. The Nifty's opened at levels of, I think, 20,800, and now it's at 20,750, 56 points higher on the Nifty. The Sensex has gained close to about 200 points. So this is a positive start. It's not a roaring start, but considering that we've held on to all of yesterday's rally, a 2% rally on the Nifty and the Sensex, in the face of weak Asian market cues, the fact that we have a green tick to begin with will be considered, fairly, positive for our own markets. The Nifty Bank is outperforming. The Nifty Bank is up close to about 0.5%. The gains are not as strong as what the pre-opening was suggesting. In pre-open, the Nifty Bank was up 1%, but it looks like it's going to be a 0.5% gain to begin with. The top gainers, oil marketing companies, so BPCL is higher by more than 1%. ICICI Bank, Axis Bank, HDFC Bank. So the top 5 gainers list on the Nifty includes 3 banks, ICICI, Axis and HDFC Bank, and they've begun trade with a gain of more than about 0.5%, extending up to a 1% rally. BPCL continues with its fantastic rally. HUL has been an underperformer, and perhaps some money is now shifting towards the laggards. On the losing side, HCL Tech is under pressure. As we told you, one of its key clients, Stateside, is looking to insource its BPO operation, which means some of the revenues which used to go to HCL Tech, the work that HCL Tech used to do for State Street, could now get hit, and we're looking at an impact of close to about 0.8% of the overall revenue. So the stock is under pressure. IT, in fact, is on the back foot. Even Nasdaq had sold off close to about 0.5% yesterday. So you've got red on the screen for even other IT heavyweights like LTI, Mindtree, and Infosys. SBI Life, Bajaj Finserv are some of the other notable losers.
Well, there are some big movers out there, Rima. I see a large trade that's taken place out there. So that stock is down close to around 2%. Keep an eye out on that one. The other big one is Shriram Properties. I recall on D Street Chatter, Nimesh had told us there's likely to be a big block out there, and a P could be part of that. Massive volume out there. I think close to around 8 to 10% equity has changed hands, and Shriram Properties is down close to around 2% approximately. Swan Energy, we normally don't talk about this, but I think there was a large trade that took place. So that stock, in fact, is up close to around 6% as we speak. DCB Bank, that one as well, is seeing a big volume spurt. The stock is trading well in the green as well. The promoter entity will invest up to $10 million by subscribing to additional shares. HCC, they'll be divesting their stake in a Switzerland company, that's Senior Construction SA. So that stock as well is up and about. And Honasa, we are waiting by for a large trade to take place. Well, the stock, in fact, had opened up a little bit subdued, but that one has recovered quickly. It's up close to 2%. There's still 100 rupees off the high that we saw in the last 10 days or so. JSW Infra as well, it opened up in the green. The Dharamtar port will acquire stake in PNP Maritime for around 270 crores. So that one as well, JSW Infra, had opened up well in the green. Prashant.
You got strong gains, right? I mean, 50 points or so, I think, is what we have on the Nifty. And you've got the Nifty Bank, which hit a new high, which starts about 0.75% higher. We've kind of fallen below the opening level on the Nifty Bank, but I mean, 0.75%. So it's a very strong start, which we have. Stronger than the Nifty, which is about 0.25% higher right now. So that's the picture. So just a few other names. Maybe Kesoram Industries will come up, about 1.5% gains there. CESE should come up. That's 3% in the green. Power has been, of course, buzzing. CAMS is up about 3%, comes up with very strong volumes. Stocks at about, almost 3,000 rupees. Bank of India starts about 1.25% higher. Stocks at 110. Moil, that is manganese ore, 4% gains, 325 on that one. There is DCB Bank, JNK Bank, 2 and 4% respectively on both those names. JNK and DCB actually, it's the other way around, but 2 and 4%. 63 Moons was up 5% yesterday. It's another 5% up right now. And then I can go down, but volumes are a little sort of on the lower side, at least on the as we start. Indiabulls Housing, came up above the 200 rupee mark after a while. I think it happened Friday. It's coming up with a small cut, 1.5% cut, but volumes are large for this point in the day. Shriram Properties, of course, Nigel already mentioned. Cyient saw a big 6-7% move yesterday. Cyient is down 4% this morning, 2,100 plus on Cyient. And M&M Finance and a few others are up on your screen. Shriram Finance, Bajaj Auto, So yeah, that's the open. It's not a bad open at all with Nifty, which is up about 50 points or so. Sunil Kaul is our market master of the day, Asia Pacific equity strategist at Goldman Sachs. Sunil, good to have you with us here. Good morning, Prashant this side. Thanks for your time. So, I mean, if you've had the opportunity over the last 24, 48 hours to speak with foreign clients, what are you hearing, Sunil? From people that we've spoken with have told us that maybe, FIs have been on the sidelines, they've been sellers. They may bring forth some of that allocations of next year to now. And generally, I mean, the mood is very positive with what we've seen over the weekend. Go on.
Yeah, right, Prashant. I mean, glad to be back. Listen, I mean, you're exactly right. I think foreign investors, which you speak to, people have broadly missed this rally, and so people are very keen to increase their allocations in India. As you said, foreign allocations look very light, and I think if you just look across the globe, where most of the advanced economies are slowing, India still looks like a market where growth is pretty steady, macros are pretty stable, earnings are growing at high to mid-teens. And so I think people are very keen to kind of look at India and increase their allocations. For us, I think we are positive on the market. We are overweight India, and we think it's the best structural growth story within the EM region.
Have you increased your overweight on India, Sunil? Given what we've seen, markets like continuity, and now the political mandate that seems to have come post the election seems to suggest that that continuity is going to last now. So are you more positive on India than you were 6 months back?
We have raised our allocations from being neutral heading into the year to overweight. So in that sense, we are obviously more positive on India. We don't have sort of more overweight than that, but we have sort of incrementally raised our allocations. So we're more positive there. I would say, look, I think elections obviously is a strong and positive catalyst for the markets. Historically, markets are also traded strong heading into the election season. But we also have to keep in mind that there has always been a sort of hope rally previously in terms of heading into the elections because of the expectation of a stable government, whereas the setup right now is a little bit different with the market already, as you said, Sonia, expecting policy continuity. So we think returns will be mostly moderate heading into elections. We think sort of earnings over the next 12 months will be will be driving the markets higher. So we're kind of looking for 10-12% returns for the markets overall over the course of next year.
Hi, Sunil. Good morning. Nigel on this side. The last time we chatted as well, you briefly alluded to maybe large caps are looking better in comparison to the mid and the small caps because some of them could have run ahead of themselves. From the large cap space, where do banks fit in? They have been relative underperformers. Valuations are looking good out there. You have earnings visibility as well. Do you think that'll be the pick of the pack from here on?
Yeah, Nigel, we certainly hope so. Look, I mean, as you said, we are overweight banks and we prefer banks over the NBFCs here. And I think, as you correctly pointed out, I think the earnings visibility still remains pretty strong on banks. The loan growth still remains pretty healthy. The capital ratios are strongest they have been in last 10 years. Valuations, as you said, are inexpensive. I think it's a sector where valuations are still kind of mid-cycle overall. I think our sense is that as heading into the elections in the next couple of quarters, the market goes back towards large cap quality names, banks should be able to perform better in that environment. Especially, I would say, I think for the banks, large private banks, which are more geared towards commercial retail, SME lending, corporate lending, as opposed to consumer lending, those banks should be doing fairly well.
Sunil, you guys have written extensively about the Make in India theme, right? Manufacturing,
That's right.
PLI schemes and the implications, etc. From that, in that area, what are the best ways to get exposure to that theme? Are these the contract manufacturers, electronic contract manufacturers? Is it something else? What are the best ideas?
Yeah, I mean, contract manufacturers for sure. I mean, look, Prashant, I mean, we like the broader manufacturing space still as a medium-term theme, but given how much prices have run up there, we're kind of much more targeted. So if you look at the broader investment cyclical universe, I would say we are most positive on cement there because it also plays into the stronger real estate construction cycle. Within the infra, I think in the next couple of quarters, probably the names that are more exposed to public infra capex, their earnings growth is likely to be kind of muted over the next couple of quarters, especially because of sort of new orders not coming through as strongly. But I would say There are other segments, for example, transportation, logistics, which we still are keen on, especially given the structural theme of shifts from unorganized to organized sector. And as you mentioned, the pickup of execution in the EMS segment, given the Make in India and the PLI. So we still kind of like that space. Apart from that, I would say if you look at the real estate, the property developer stocks have already run up, and they're probably factoring in the next couple of years of growth already. So we are more market with that space, but we like to play that through building materials, not just cement, but the broader sort of material space, which will include, for example, tiles and sanitary laminates and all of those. So I think we need to be a little bit more targeted, especially in the next sort of a couple of quarters there.
You know, Sunil, getting into an election year as well, cement could look up, consumption will move up, infra push as well is likely to come about, and the housing sector is doing well. But what's your preference from the cement pack? And I ask you this is, because the large were getting larger, but now some of these smaller names, well, they're coming up for sale or, mergers, acquisitions, and that's where the real value is unlocking. So do you stick to the large names, or do you believe some of these mid caps, they offer more value?
Yeah, I mean, we still have, within the broader cement pack, we still have buy ratings on some of the large caps names, the biggest kind of cement manufacturer in India. So from that standpoint, I think we will, as I said, our preference overall over the next couple of quarters is looking at kind of large caps or mid caps. And I think within the cement pack as well, our preference will lie into some of the large cap names there.
Sunil, what's the big top-down global equity call for 2024? Because in the last 2 months, the macro headwinds have eased, whether it's oil prices, the price of dollar, yields have come off very significantly. And now we're staring at the prospect of no recession in the US. They've pretty much managed a soft landing despite the sharp increases in interest rates. So what's the global equity call for next year?
Look, I mean, we, as you may know, Sonia, we never had a US recession in our forecast. We always had a soft landing view, and seems that the market is also kind of coming to that view. But as a consequence of that view, we also think that Fed doesn't need to cut rates anytime soon. So we have a rate backdrop, in which case we think rates will be higher for longer. So we don't see Fed cutting rates until Q4 of next year. And so if you sort of therefore look across the world, we do think if rates are going to be higher for longer, there is not as much juice from valuation re-rating from current levels across equity markets globally. What that means that you will have to rely on underlying earnings to drive your markets higher. So in all the sort of major regions across the world, in terms of US, Europe, Japan, and Asia Pac, we are kind of looking at earnings growth more in the high single-digit territory. Asia, obviously, there's a large dispersion within that. But broadly, as an aggregate group, we are kind of looking at 8-9% aggregate earnings growth across the geographies, in which case our global equity returns across these 4 regions are sort of in high single-digit territory. So we're kind of looking at an environment of modest high single-digit returns for the broader markets. And within that, if you sort of pick the pockets rightly, we think for markets where earnings delivery is stronger and India kind of fits into that bucket, you could see even stronger returns.
But will the markets be disappointed if we see Fed cutting rates only in the last quarter of next year? Because market right now is penciling in cuts of 100 to 150 basis points next year.
That's right. I think we do think market is pricing in a bit of too much easing in the curve. And so from current levels, we don't think, whether it's kind of looking at the short end of the curve or also looking at the US 10-year rates, we don't think rates go materially lower from current levels in the near term, right? So from that standpoint, we do think the market may need to kind of reprice some of those expectations which have been built in. Because as I said, the underlying fundamental reason for that is we do think that the underlying US economy is still strong, and Fed therefore doesn't need to cut rates anytime soon. I mean, if we do see growth data worsening, and then the Fed could have early rate cuts in terms of more insurance cuts, but we don't see the need for that at this point in time. And by the way, that kind of extends. Sorry, I was about to say, I think that extends to our view in India as well, because where we think that RBI will stay on hold pretty much for until Q4 of next year, and even when the rate cutting starts, it'll be much more a shallow cycle for RBI too. But that is also contingent on our global view, as I said.
Well, central bank action aside, Sunil, what's the other big risk for the Indian markets? I think things are looking very good. The flows are coming in there. We are likely to have good leadership at the center, continuity of the ruling government. Crude oil prices refuse to move up. Goldilocks scenario for us. Where's this coming from? Valuations?
Yeah, I would say, look, the most pushback we are having from investors is that of valuations. I think the fact that India's macros have been stable for a while, I mean, the earnings growth numbers are coming through. I mean, it's been 3 quarters in a row where earnings are coming in better than expected, and people can understand the story now. But I think the pushback we still get is that valuations are somewhat still on the expensive side. What we would note, by the way, is that if you look at the market, obviously at the all-time highs, multiples are not deep multiples. So a year or so back, market was trading this MSCI India in aggregate 23, 24 times forward earnings. Right, we are more like 21 times. And the reason for that is if you look at the underlying earnings that have grown this year around 18-20%. I mean, the 3 quarters, 4 months of calendar 2023, earnings have grown close to 30%, even with some kind of base effect. But incorporating all of that, we think earnings in calendar 2023 would be north of 20%, for example. And if the underlying market is only up 11, 12, 13%, that means effectively markets are derated. So I think what would happen is that you have another year of strong earnings, and if the market, if you're right, is only 10, 12% up, if the multiples would start looking even more reasonable. So at this stage, the fact that we haven't seen flows coming as much as it should have been in India's stable macro is partly because of valuation. I think as the market kind of digests some of these evaluations by underlying earnings, you could see more flows come back in.
Okay, so we'll leave it there. Thank you very much for your time. Great speaking with you here on CNBC-TV18. So that's the perspective coming in from Goldman Sachs, one of the top sort of sell-side research houses with perspective. Look at a few stocks before we go any further. By the way, Nifty's up 67 points and, it's looking pretty good. Radico is up 11%, 12% on Radico. I mean, actually, started slow and it was nowhere in the mix. When we looked at stocks at 9 a.m., actually the opening price was 1646 this morning, and now it's at 1830. So almost all of the gains have come through in the last, 20 minutes or so we've been trading, but not at the open. So the open was flat. So that's a big one which has come through. And maybe look at names like BHL. BHL is up about 4%. And the stock like something like a Honasa, which had been correcting, that is up about 2.5% or so as well. So, I mean, it's a good-looking screen with more into the mix with 15 or 20 minutes of trade behind us now.
Well, you have to just, maintain the positive bias, trail your stop losses. And in fact, this market looks like it wants to move up after the kind of rally that we're seeing. All those intradays are getting positive. But then move on. CNBC-TV18 is entering its 25th year this week. And the management in focus right now is Cummins India. Well, it reported a rather mixed set of numbers for the past quarter. Revenue was impacted, though, due to weak export sales. Mr. Ajay Patil, the VP and Chief Financial Officer, India, at Cummins India, joins us on the show. Hi, Mr. Patil. Good morning, and thanks so much for joining, and thanks so much for being part of our journey last 25 years. So, let's talk about a couple of aspects of business, though. How much of the CP-CP2 inventory is still sitting on the books, or is that completely cleared out? And also, what kind of price hikes have we undertaken, not on average, for CP-CP4 in comparison with CP-CP2?
Good morning to all of you and viewers, and congratulations for your silver jubilee year. It's been a remarkable journey, so wish you all continued success. I think turning back to results, I think when we look at it from a quarter perspective, you asked a question about CP inventory. As all of us know, with respect to the way the regulations are getting implemented on the emission side, there is an extension of time which is added till June of 2024, which means both emission compliant products will be allowed to be sold up to June 24. So as a consequence, I think the extent of pre-buy that I experienced in Q1 before the July, originally planned July 1st date for switchover, meant that pre-buy inventory to a certain extent got liquidated in the quarter, plus some is getting flushed out as we speak. And the second question on the pricing side, because currently there are both sets of products which are allowed to be sold, price discovery for the new products which are compliant to CP-CP4 plus is I would say a bit early to say what the real trend is, because although we have all the products ready and made available in the market, the price discovery and the stability of where exactly those prices are and the quantum of increases is something which is yet to be fully discovered.
Okay. All right. About that, Mr. Patil. So some kind of uncertainty out there, and we'll have to wait maybe for a couple of weeks or months before we get better trends on that front. Let's focus on exports, though. There was a bit of a hit last quarter itself, but what stood out was the HHP exports. Out there, you did see growth, and that was a little bit unusual. Now, given the global commentary on EU slowdown, do we expect to maintain this sort of a growth on HHP exports? And similarly, what's your view on LHP exports?
Yeah, I think on the HHP exports, when we see it in the context of half year, we own 9% there, and we have anticipated some sort of a slowdown in the Asia-Pac region, which did occur in with what we had seen. However, the rest of the geographies have kind of hold on to the demand, as far as the high horsepower segment is concerned. I think on the low horsepower, we were anticipating a slowing down, primarily coming out of Europe and Latin America region. And that is the reason that particular line of business on the low horsepower side, we expected and anticipated a softening of demand, which did turn out to be case for the first 6 months. And the attribution of softness is a function of what's happening to those end markets. And that, I think, is the reason why the demand is softer on that side.
Just one question, sir, on exports, then put it together, low and as well as high horsepower, put it together. You expect to maintain this run rate of at least 500 crores given the challenges as well on a quarterly basis? Will it be a little bit higher?
Yeah, our endeavor is, of course, to, it's a very important piece of our revenue profile with respect to how we balance our revenue between domestic and exports. So we, of course, continue to believe that we have the right product. We have a fit for market strategy for each end market. That strategy has worked. And we continue to make those efforts to see that we win the fair share of market as far as our exports are concerned.
30%, I think, right? Revenues or exports. Mr. Patil, hi, good morning.
Hi, morning.
In the conference call, you said that revenues will grow 2x growth, India growth. On a lighter note, maybe only half joking, but growth is now almost 8%. So you want to bump up your own revenue growth guidance?
Well, I mean, if you see it in the context of where we are from a H1 perspective, I think we've grown 13% on a 6-monthly basis. Our guidance was that we grow 2x of GDP. So we are keeping pace. Obviously, understand the expectations that we need to sort of continue to do more. And I think that's well understood. And we make all our efforts to see that we sustain our growth momentum, what we have experienced in the last 6 to 8 or 12 quarters.
You've also guided, sir, for 100 basis points of margin expansion in FY24, given your strong focus on cost management. But can you give us a longer-term trajectory on margins? This cost management exercise, will it extend into FY25? What is the eventual guidance on margins in terms of an improvement from here?
I think what you have seen, how we have delivered in the last 8 quarters or so, I think we continue to take efforts, and through a combination of what we have been constantly speaking is a 3-pronged effort on how we drive a volume leverage with respect to our margin expansion. We continue to be prudent with our cost management exercises, and pricing is something which we have been very tactically positioning in order for us to continue to get the value. All of these factors, when you put together, I think overall, when you see how our PBIT growth has been on a 6-month basis, I think on a 13% top line growth, our PBIT year on year has grown 38%. The 100 basis points guidance that you reference to is really a very long term. It's not a guidance per se. It's how we think the profitable growth should be translating into. If we are growing 2x of GDP as a guidance, then it should translate. So that's how it is. It's really not a guidance per se. But our endeavor is there that year on year, we continue to have a margin expansion. And we do believe that where we are positioned today with the favorability on the commodity side, plus the volume leverage we are able to get, and the cost management, I think our endeavor is to keep the profitable growth trajectory.
Mr. Patil, just in terms, just to go back to the top line thing, I think you also mentioned that you were expanding the product sort of profile, right? Expanding the addressable market. I think railways is one segment you've spoken about. Marine segment, mining is another area. You're saying you're pretty close to getting approval for Vande Bharat trains. Could you talk to us about all of these, and what's the total addressable market for you in your product category?
Yeah, just to clarify, I think on the Vande Bharat train, we haven't provided any specific commentary, so just a correction there. But I think within the line of businesses that we have and the markets that you referred to are what we call generally our industrial businesses. I think on a 6-monthly basis, that has grown 10% year on year. It has an element of a bit of a lumpiness depending on how the type testing and other approvals come through from the customer. But the end markets in that particular segment, when you look at railways, construction, compressors, marine, mining, those are all broadly aligning to the macros. And therefore, we are quite optimistic about these end markets holding up, given the way the macro trends are, where the government's emphasis on infrastructure is, And we believe we have the right product and applications in order for us to get a share in those markets. So that really bodes well from an end market perspective.
Mr. Patil, just want some clarity out here. In terms of supply side issues, most of them are ironed out. If you could just confirm that. And also for the year, just to reiterate, double-digit revenue growth is what you're looking at. And margins could be 100 basis points better in the second half in comparison to what you've seen in the first half?
Well, so getting started with your first question, I think on the supply side, as we stated on the earnings call as well as in other communication, I think there is a very, very specific electronic components which are currently still in what we call managed demand. That means we are not getting the exact level of quantities that we desire. But that is not impacting any order statuses or any of those impact as a result of supply chain. Only thing, the revenue gets deferred should there be any constraint in a particular quarter for those specific components. Number two, with respect to the guidance on the 2x of GDP, I think that continues. I think we are holding that guidance as we stated on the conference call. The half-yearly results are certainly in line with that guidance. And that's what our endeavor is to see. We continue our 2x of GDP growth rate from a current year perspective. On the margin side, as I stated on my previous comment, I think our endeavor is a profitable growth, and the profitable growth indicative of the margin expansion. How specific, how many bips of margin expansion, I won't be able to specify that number for you, but all I can say is that that's how we are looking at in terms of how we grow profitably.
And the endeavors to gradually move towards 20%.
Well, I mean, we continue to sort of do our best. Won't necessarily provide any guiding comments, but profitable growth is what we really focus on.
Got it. What about industrial and distribution? That's a segment which is growing well for you. Can you share the outlook?
Yeah, I just made some comments about the industrial business, and you asked about our distribution business. That's really, that is something which has done well, I think, on a half-yearly basis. It's up 26%. I think this is 3 years in a row what we have seen that this business has really done well. There are multiple different ways that we are looking at our services business today, right from the annuity side of the business to the parts and services. And the reason we are able to maintain this high growth rate for 2 years in a row is primarily because we possibly have one of the best service infrastructure in the country. Our guaranteed response time is 4 hours nationwide in terms of how we serve our customers. Our goods are capital goods for the customers. They are productive tools for our customers. So we are very, very sensitive in terms of how we provide responses to our customers or service calls, because they add to customers' productivity. And I think that is getting well responded in terms of how our customers look at us in terms of our service standards, the quality of service we provide. And that's the reason we maintain that trajectory.
All right, Mr. Patil, we'll leave it there. Thank you very much for your time, sir. It's a pleasure having you with us here this morning and speaking with you. Thank you for that. We'll take a very quick commercial break here. On the other side, we'll take stock of the market, which, by the way, is looking better. We're up 90 points on the Nifty. We also will bring in the management of Bharat Electronics to talk about how business is looking for them. Stay tuned. A conversation coming up next.
Welcome back. Markets holding on to gains. It's 20,787 on the Nifty, a good 100-point rally, while the Sensex has picked up close to about 300 points. Let's get you another corporate conversation going. My colleague Vivek caught up with Bhanu Prakash Srivastava, Chairman and Managing Director at Bharat Electronics, BEL, and began by asking him about the demand trends and whether the company is on track to achieve their order inflow guidance for FY24. Listen in.
Yes, as far as our business performance, it is on track, though there are challenges in execution front, but our team is working hard to sort it out. As far as order inflow is concerned, yes, we stick to our guidance. Even up to, if you see 31st October, we have already clocked around 16,000 crore plus order. And seeing the pipeline, we are definitely going to cross 20,000 crore guidance, whatever we have given.
So that's great to hear. So you're saying that there is an upside risk as far as the order inflow guidance is concerned.
Yes, it is definitely going to be in plus side.
So that's great to hear. So the earlier FY24 inflow guidance was 20,000 crore. The company says that there will be an upside to this particular number. Along with that,
Yes.
FY24 revenue guidance you had given between 15 to 17%, a 40 to 42% gross margin guidance, and a 21 to 23% operating margin guidance. So any upside risk to these figures that you've given analysts earlier?
See, we stick to margin guidance of that 40 to 42%, and we also stick to that EBITDA margins, what we predicted around 21 to 23%. As far as revenue is concerned, yes, seeing the conflict between Israel and Hamas, because we have certain projects which are dependent upon Israeli supply, we are finding some challenges which we are trying to sort it out. The way ceasefire has happened, we hope that things will be back to the normal, and we will be able to achieve our revenue guidance of around 15%. 15 to 17, what we were telling at the start of the year, now maybe around 15% we will be able to do because of these type of challenges which we are facing in the market.
So the key takeaway so far has been that order inflows continue to remain quite strong. Execution challenges do remain. So as far as the revenues are concerned, as far as the top line is concerned, it'll probably be at the lower end of the guided range. We understand that, sir.
Yes.
So talking about Q2,
we are very confident that we will meet the guidance. Maybe it may be at lower side.
Absolutely, sir, absolutely. So Q2 was quite a strong quarter for you. Strong margin expansion as well. However, you did mention, in the analyst call a little later, that there was a certain portion of the revenues that was deferred to Q3. Can you give us some more light on that? And how will Q3 look in terms of revenues, especially given there will be some deferred revenue recognition from Q2?
Yeah, see, some deferred revenue from Q2, it shifted to Q3, but seeing that challenges what we are facing, some revenue may be deferred from Q3 to Q4 also. So Q3 will be a normal what growth we get, and it will be more tilted towards our major things may happen in Q4. This year Q4 will be a little bit heavy because of some deferment of revenue from Q2 to Q3 and some Q3 going to Q4.
So we also have to keep in mind that H2 is also the run-up to the elections. Against that backdrop, how does ordering activity pan out as far as on-ground is concerned? Secondly, in terms of big-ticket orders, what we understand is that the QR-SAM segment is better compared to the MR-SAM segment. So can you elaborate, where do you see further or incremental order inflows coming from, especially in the surface-to-air missiles?
See, I don't think election is going to have any impact, at least order inflow on BL is concerned. We are, anyway, we will be exceeding what guidance we have given in order inflow in 23-24. Because whatever predictions we have given, we already reached around 16,300 crores. And that orders from shipyards, especially GSL and GRSC, are definitely going to come in this financial year. Similarly, that EW system, ship-based EW system also is going to come. And fuse orders, which has been pending for a very long time, and it has been going through the process of acquisition in MOD. What I understand, it is at the last stage. So anytime it can come. So definitely order inflow, we will be exceeding what guidance we have given. As far as QRSIM is concerned, services are in the process of finalizing the GSQR and then making the statement of case, then going for A1. So this is this will be most probably next year only these things will happen. And the ship-based order, another land-based order, many orders are in pipeline. MRSIM also they are discussing. So these things will come in next year and next to next year. So election may not be having much impact as far as order inflow and BL is concerned. And this year, definitely it is not going to have any impact.
So I'm going to try to pin you down to a number. The current order book is in excess of 68,700 crore. With all of the order inflows that are expected, where do you see yourself ending FY24 at in terms of the total order book?
See, I have to calculate that we have not. See, we are targeting a turnover of around 20,000 crore, roughly 19,500 to 20,000. If we say that guidance of 15%, we are reaching there. So half yearly, we did around 7,300. At the end of October, it was around 8,300. So if you see around 12,000 crore revenue is left out. And order inflow, we are at around 16,300. So 12,000, 8 to 10,000 is coming. So it may be around the same range. That's what we see. Exact figure, you come to know on 31st March where we ended up.
Okay, that's the management of BEL in conversation with my colleague Vivek. The market is up in triple digits now. 100 plus points on the Nifty is what we have, 20,800. So going back to the day's highest point. And maybe just before we move on, look at the Nifty Bank as well, which is up about 1 1/3%. So that's a sharper move on the Nifty Bank after making or hitting and crossing and closing above the previous all-time high. So more on markets and stocks in a bit, but CNBC-TV18, as we've been telling you, is entering its 25th year in 2024. This week, we are entering the 25th year. The next management which is joining us on this occasion is JSW Energy. The stock, remember, is down about 45% this year. The company, JSW Energy, is targeting 20 gigawatts of generation capacity by 2030. Remember, there's also news flow with regards to top management reshuffle. The company is named Sharad Mahendra as the joint MD and CEO designate effective the 1st of February. The incumbent, Prashant Jain, who's seen the growth so far over the last couple of years, will continue in his position until January 31st, 2024. We have Prashant joining us now to take some questions and sort of run us through his journey and what he sees as the future for the company. Prashant, great to have you with us here. Good morning. Thanks very much for joining us on this happy occasion. Prashant, this side. You know, first of all, take us through your decision. Now, I'm assuming you can talk freely about your decision to move on from JSW Energy because so many changes, new initiatives, etc., are taking place. It's an area where there is a fair bit of bullishness. Markets were taken by surprise. What do you see in terms of the road ahead for JSW Energy, and what is going to be the big handover, the messaging to the incoming CEO? Go on, Prashant.
Yeah, thank you. So it has been a personal, reasons because I wanted to pursue my personal goals. It has been 31 years in the industry, 28 years in the JSW group, and I have seen, the group rising, and I have been could play some important, meaningful role during this growth journey, and so I think now it was a time to hand over to the next leadership, and that's where I see the company at this point of time. It is taking major strides in the expansion and also in the energy transition, and so that the future is absolutely very, very rock solid and bright. And as you also talked about in the opening remarks, that the company has already taken the target to go to 20 gigawatt of the generation and also into the energy storage solution. So each and every project is moving on track, and probably you will be getting surprised with the aggression which the company will be showing in time to come.
Prashant, would you be staying in the corporate world? I mean, in a new avatar, would you be doing something on your own? Would you be joining another group? Anything you can tell us?
So nothing is decided yet, but yes, I'm not going to be joining any other corporate group. So whatever I'll be doing on my own.
Okay. 28 years, JSW Energy, 6 years at the helm. What are you most proud about, Prashant? And in terms of an unfinished business that you wish you could have achieved in your tenure, what would that be?
So I was really excited about the seeing the company into the growth mode, because after 2012 the company was not growing, and so was the power sector, and that's where I saw the major shift which was happening. And I was the only person who has been calling for a power shortage for last 2 years, and that's what I was seeing on the cards. So that was the major proud movement for me, to put the company back onto the growth mode, and then participating into the energy transition track, and also bringing down one of the industry leading the cash flow ratios as well as the return on equities. So those are the things which I saw very categorically. In terms of the unfinished agenda, I think the energy transition story, which is just started, and also electron to molecule business, which is towards the green hydrogen, and also from electron to molecule side, getting into the specific chemicals. This is one story which I see is going to pan out over 1 or 2 decades.
Hi Prashant, good morning. Nigel on this side. It's been good interacting with you as well over the last few years, and we've had quite a few good interactions where you've given us the outlook with 2030 in mind. Since you're moving on, I just want to get a sense in terms of pricing as of now. What's the updated pricing number for November and December, and how do you see merchant rates stabilizing?
So the power tariffs are down. They are now close to 4 rupees at this point of time, because the November month power demand was little subdued, but yes, it was quite robust at 8.5%. But because of the seasonality as well as the festive seasons, there was a lower demand, and then power prices went down. But going forward, I see the power prices will be again picking up. So on an average, you will be seeing the power prices will be in the range of 5 to 7 rupees for next 5-7 months time period.
This is merchant rates?
Yeah, this is the merchant rates.
Okay. In any case, I mean, in a way, the ceiling is 10 rupees, right? I mean, most of the maximum is about 10 rupees.
That's right.
Okay. So, and you're saying that you expect rates to stay between 5 and 7 rupees
That's right.
from here on?
Yes.
Okay. Okay. We had the management of REC yesterday with us, Prashant, and they were talking about the big funding requirement in the renewable space. The numbers are mind-boggling, right? 30 lakh crores is what they're saying they need, the industry needs to set up 320 gigawatts of power in the next 7 years. In your assessment, just sort of putting on the industry hat, is that what investors should kind of focus on? Is that where the next big money is going to be made? Because on the thermal side, there is addition which is required. The power minister spoke about it about a month ago, but that is kind of limited, right, till the next few years. The long runway is for renewables. How do you see it?
No, that's true that the long runway is going to be the renewables, but it is going to be blend for immediate 3 to 5 years time period, because India need to yet catch up with the capacity addition targets. So like if you look at that, power demand so far is 8.5% up year till date. So you are talking about some 16,000 odd demand increase. And if you want to do it with a blend of like thermal, 30% thermal and 70% renewable, you're talking about some 40 gigawatt odd capacity, which will be added up, which is calling for approximately, you can say that 200,000 crores every year capital expenditure. So next, if you are talking about 6-7 years, that means you're talking about 14 to 15 trillion rupees capital expenditure only on the generation side. So that's what is going to be funded by 75% debt and 25% equity. So you are calling for some 11-12 trillion rupees only on the generation in the power sector in time to come, which will be required to take, any power developers need to take it from the financial institutions. And there will be an incremental amount will be coming for the grid, I mean the transmission sector, as well as the storage solutions, which will be also required along with that. So the numbers are going to be quite good in terms of the credit inflow point of view, and power is going to see a substantial capital expenditure in next 5 to 7 year time frame.
Prashant, we'll leave the conversation here for now. Good luck, and in case we don't speak to you before the 31st of January, wish you all the very best. We will slip into a very short break with the news that the Adani Group stocks are on fire. The top two gainers are Adani Ports and Adani Enterprises. Adani Ports is up 6.5%, Adani Power is gained 4.5%, and even the others like an Adani Green 5.5%, Ambuja, ACC up close to about 5%. So the rally, this big bull rally in the Adani Group stocks continues for yet another day. On the other side of the break, we'll put the focus on commodities. Manisha Gupta joins us next. Knocking on the doors of 20,800, it's 20,797. The high today was 20,813. So we're practically at the day's high. Momentum is picking up. The Nifty Bank is outperforming. It's another 500-point rally on the Nifty Bank. And this follows a 1,600-point gain that we had in yesterday's trade. So the outperformance of banks continues. Mitesh is back with us. Mitesh, thoughts on the first hour of trade and how would you approach it and your stocks?
Yeah, I think very good continuation being seen. So I think stay long. That's the idea. And on the stock side, I have a buy on Federal Bank, which I would recommend buying with a stop at about 155 for targets of 166. And the other one is India Mart. That's a stock which has come on the radar after a long time. It's trying to reverse on the upside. So buy here with a stop at 25.95 for targets of 2,700.
Got that. Thank you very much for that. Let's turn our attention now to commodities. Manisha is back with us. Manisha, what's the one commodity you're tracking?
Well, I'm looking at metals as a sector because, we've seen a strong last 3 or 4 weeks where we've seen gains come in for many of these metal prices. But the last 1 week has finally seen some profit taking coming in. We are looking at markets where you have the US dollar, which is strengthened. We've seen rupee decline quite a bit today. And that is the case with the Asian currencies as well. And that has led to some decline coming into those markets. If you look at the gold prices, yesterday was an all-time high at 2,150. But if you look at the prices currently, we are trading at $2,050 an ounce, which is $100 of a profit taking that we've seen in last 24 hours as well. So the speed at which the gold went up also has come down in the same way. There were some stop losses that were triggered and is the reason we saw the prices gain up so much. But the wealth funds and ETF buying in gold has pretty much continued. That is the case with silver as well. We saw the prices run up quite strongly, but we're trading off 7-month highs on this one too. Overnight decline for silver has been to the tune of 3.5%. If you look at the industrial metals, the profit taking there also has seen a spillover effect. Copper prices declined by nearly 2.5% overnight, and we have come off those 4-month highs that we were trading in the last week itself. It has been a decline in the zinc prices, which are now trading at a 1-month lows. Remember, zinc inventories have surged quite strongly. They are at a 2-year highs right now. And the International Lead and Zinc Study Group says that with the kind of surplus that they were working in the previous year, which was at around 156,000 tons, this year is estimated more than double of that at 489,000 tons. So zinc is going to find it very difficult to gain from here on, and the markets are looking at pressure therein. If you look at the prices itself in the last 1 week, we have seen profit taking come across board. The only one that is trading in the positive is copper, up 1% in last 1 week. Apart from that, everything else has seen a decline come in. Zinc, as we've been talking about, is down almost 4% in last 1 week itself. And the other metals which have seen sharp decline in the last week have been lead and iron ore, down between 3 to 4% onto these as well. What the street is watching out now is the China trade data that comes in on Thursday, and you have the US non-farm payroll data that comes in on Friday. So those couple of days are going to be quite important.
That's going to be the crucial labor market data investors are watching, and will it confirm that perhaps we're in with all the US rate hiking cycle? The next FOMC is on the 12th and 13th of December. That's next week. But let's get to the big mover, the stocks in the move. Shriram Properties. Nimesh joins in.
Hi, Rima. So, Shriram Properties in focus largely on the back of a large block deal. Nearly 10% equity has got changed hands in today's block. In terms of participants, I understand from a seller perspective, the large PE investor was a seller in today's block. So technically, it's a clean out trade from that large PE investor. So they've completely sold out. In terms of buyers, a few large HNI investors were buyers, as well as some hedge funds as well. So well bid book, the demand was quite strong is what I understand. So that's from a deal perspective. So one, it's a clean out trade from a large PE investor. Additionally, I understand the Shriram Properties is also looking to monetize its land bank and raise close to 300 crores. So that's the next figure to watch out for. But from today's deal perspective, the PE investors sold out and some large HNI investors have bought.
And you had alerted us on D Street Chatter, so you should catch that segment at 3 p.m. every day on Closing Bell. Nimesh had told us just last week about the possibility of this deal. We will slip into a very short break. On the other side is our special segment. It's the economy. Lata will get chatting with Puneet Chadwal, Managing Director, CEO at the Indian Hotels.
CNBC-TV18 is celebrating its birthday week. And speaking of celebrations, one has to think of Indian hotels. Besides the fact that we want the best corporate guests on the channel this week, the big reason to invite Indian hotels is that the hotel industry has had a super October because of the World Cup, according to data we got from HBS Anarock. That's an industry data company. Revenue per available room jumped 27%, says Anarock. More important, the KEIT, or the Confederation of All India Traders, says that this winter there will be 35 lakh weddings, which is 7% more than last year, and the expenditure on them is expected to rise by 27% to 4.74 lakh crore rupees. To give us an idea of how busy is this season, I have with me Puneet Chhatwal, Managing Director and CEO of Indian Hotels. Good morning, Mr. Chhatwal. Always a pleasure having you with us, especially when it is celebration time. Before I come to this celebratory months, November to March, how was October? Is it, 6%, 10% better than a year ago because of the World Cup?
Good morning, Lata. I think it'll be fair to say that every month has almost seen a double-digit increase over the last year. And I see no reason why this should decline. Depending on what your portfolio is, how it is spread, it would be fair to say that for the sector, we're witnessing at least a 15% increase in revenue over last year. So the figures given to you by HBS Anarock on RevPAR are accurate also accurately reflect what is happening within our brands. And depending on the base that you're coming from, so once the consultants do it across the entire supply, so 27% across entire supply is good, but some of our brands like Ginger may show 25% increase, Taj may show 15% increase, but coming from a very high base. So we are very pleased with the way revenue has evolved and the results we have declared in Q1 and Q2. In the interim, November is also finished at a very positive note, and the business on the books in December is also trending higher than last year, which was a great December.
Okay, well, that's what I was coming to the November, December, and for that matter, even Jan, Feb, March, which is really the big wedding season in India. And this data from KEIT indicating that it's going to be another 27% higher in terms of expended expenses, expected expenditure, sorry. What's the scene for you, both with respect to December and the fourth quarter? All booked out, and are rates also higher in terms of the wedding demand?
Lata, the rates are trending approximately 17% higher across our portfolio for us. We are very booked out in certain locations, Rajasthan, Goa, Mumbai, Delhi. This is also because of a lot of events that are happening. Jio is hosting a lot of events in Mumbai. Yashobhoomi is getting new events like the investment conference. The auto show is happening in Pragati Maidan. So we see a lot of business going back to the way it used to be. That means booked in advance. And obviously, we are picking up a lot on the short term because of the holiday season, because of the wedding season. And as I said before, anything between, depending on where your portfolio is, which brand within the portfolio you speak about, anything between 15 to 20% on the top line is pretty much a safe bet.
Okay, no, I agree with you, because we did our India Business Leader Awards and we didn't get Jio, nor did we get the Taj Ballroom, because they were all booked out. I can understand, the lack of availability of rooms. Speaking of IBLA, one of the big chatter among the guests is that there is no room available for any holiday destination. So can you tell us something about tourist arrivals? In my last visit, Ajanta Ellora last week, I saw a lot of foreign tourists, and not just English speaking. There were a lot of them, foreign European tourists not speaking English. But what's the demand in tourist locations?
We are getting close to the pre-COVID level. We are still not there because statistics, sometimes can mislead you. This is the year of G20. A lot of delegates came into India. They're counted as foreign tourist arrivals, but that is like a one-off. So there is still room for growth in the foreign tourist arrivals, and that is beginning to happen, especially in Delhi, Mumbai. These are the main airports you come into besides Bengaluru. And then you have Rajasthan and Goa being, still ranking as the top destinations where the tourists are coming, and they are actually combining a lot of business with leisure. So there's a lot of interest. And as your channel keeps showing, it's the economy, it's the impact of the aspiration of 7 trillion in 7 years. That is taking charge from the interest from a lot of foreigners coming into India, and we are seeing that a lot.
Okay, what's the sense in terms of margins? If I remember right, you did 28% in the first quarter and almost 25% in the second quarter. Will second half be better?
Always. Q3 is the best quarter, Q4 is the second best. And, this sector, actually, if you look back historically, 20 years, 30 years ago, we always were happy if there was a break even in these first two quarters. So both the quarters 1 and 2 have been record quarters for us also versus last year, which was the best ever Q1 and Q2. Now this year has been better than last year. Q3 is trending in a similar way. Unless something dramatic happens in the next 3-4 weeks, I see no reason why Q3 should not be all-time high. And the margins are really the best in Q3, followed by Q4.
Okay. That's good to hear. All-time high revenues for Q3 and Q4 likely to follow suit. Well, I wanted to speak about CapEx. Now, what this ANAROC data indicate is that from FY23 to FY28, the demand compounded annual growth, CAGR, is 7.4%, but the CAGR of room of supply is 6%. So it looks like the demand-supply gap is widening in favor of the hoteliers. What are your CapEx plans? Would you want to take advantage of this gap?
Well, Lada, we have communicated very clearly our strategy of under Avant 2025, and the majority of our growth is coming through fee-based business. But like we have always historically done, we are also building new destinations. The last one that we did was Havelock in Andamans. We've just opened the flagship Ginger on the you see it very close to Santa Cruz, Villepale on the main road.
Yes.
Which has just been launched like 10 days ago, which we built with our own, own cash. And then also we are building new destinations like Lakshadweep. We're also doing a Ginger and a Vivanta in Ekta Nagar, which is where a Statue of Unity is. So I think selective investments which are strategic, which help in nation building, we will continue to do that. That has been the tradition of our company, but as well as the Tata Group. So I think some of that will keep happening, but the majority of our growth will come through fee-based business, or when it comes to brands like Ginger, will be through operating leases.
Okay. You told us what we know from analyst meetings, 15 hotels lined up for opening in H2 FY24, 82 lined up for opening until FY28. That would be about 11,000 rooms, is what you told us. Going by the demand-supply gap, will you want to increase this?
We are always happy to do more and happy to do both organic and inorganic growth. I think if somebody would have said a company which is celebrating not its birthday this week, but the following week, Taj will be celebrating 120 years. On the 16th of December. We have actually signed and contracted 140 hotels in last 6 years. And by 31st of March, we would have opened 72 hotels in 72 months. I think that speed was, nobody would have thought would have been possible, and also to absorb it profitably. So most of our new openings are also trending at an EBITDA of the average is across the portfolio is higher than 30%. So I think all in all, we are very pleased with the growth. Growth is a fundamental and a strategic part of our strategy. And it's not just growth in number of rooms, it's also growth in other brands. We introduced Homestay with Ama. We introduced Cummins as a QSR and home delivery. We have brought in many new food and beverage brands. The latest one is the Captain Cellar, the kind of a European vinotheque at the Taj Mansingh in Delhi. And you will see a lot of new additions in your own city of Mumbai.
Okay. Any update on Sea Rock?
Well, I'm happy to share that that we have received the fire NOC, and at a recently concluded conference of the which was held at the Hotel President, the government representatives declared that as a part of the Maharashtra's $1 trillion aspirational ambition, they have taken an approval for a certain number of projects, maybe 10 or 14, I don't remember the exact number. And Sea Rock happens to be one of those. So all in all, this development is also beginning to look positive for us. But this is like happened last week.
Okay. Well, point taken on that. Mr. Chhatwal, it's the economy. So I was looking at the hotel industry, really. I haven't even touched on religious business. Religious business itself is booming. But I just wanted to take time out in terms of your own ROE compared to, say, a small rival like Lemon Hotels, like Lemon Tree. You know, their ROE works out to 24%. Yours works out to about 16, 17. So is there something internal that you're doing to improve ROE?
Well, I think you have to look where it was 5 years ago or 10 years ago. And from looking at that, the rate of growth in our ROE and on our return on capital employed is very significant. And also, you know, Lata, you don't always take a percentage to a bank account. Is the absolute amount. And we posted 1,000 crores profit after tax in the last financial year. The way things are going, we should match or exceed that number easily. And we don't have debt. And we have cash reserves. And we are very well positioned in terms of all metrics. So I think percentage level, as I said, it depends what base, what business. And instead of Lemon Tree, if we just did like Ginger, things would look very different. If we would look at Ama, which has no capital, upfront capital investment, or Cumin, the ROE number would just go through the roof because it may not be even possible to calculate it. So I think it all depends on the assets you come from. And our strategy that we have communicated is to remain the most iconic and most profitable company from South Asia. And you cannot be most iconic if you don't keep investing into your Lake Palace, into your Taj Mahal Palace in Colaba, which is a temple of hospitality. So I think that's very important to see what your portfolio is and compare, I would say, lemons with lemons and oranges with oranges.
No, I take your point entirely. I wouldn't want Indian hotels without the Taj at all. We wouldn't want you to be just a business hotel. Lots more to discuss. I'll take a rain check from you for another chat another day. But good to hear that business is booming, both in Q3 and Q4. Thank you very much for joining us, Mr. Chhatwal. And in case I don't speak to you, have a great 2024.
Thank you. Thank you, and all the best to your channel on your birthday.
Thank you so much, Mr. Chhatwal. We wrap up on Bazaar on that high note. Chartbusters up next.